Hello, I'm Vanessa Stoykov, the CEO of Evolution Media Group, and today you're joining us on Wicked Problems, Visionary Investors, a program where I combine world-class investment experts, investors and advisors to help solve some of the biggest wicked problems we face today. So, what's today's wicked problem? Let's find out.
Today's wicked problem: how do we understand the best way to invest sustainably as more investors are considering ESG? Why is sustainability so important for investors now? And how can advisors approach the critical factor of sustainability when it comes to investing?
It is without doubt a wicked problem. So how to solve it? Joining me today are Stephanie Hukins, Sustainability Investment Director at Shroeders, and Damien Graham, who's the Chief Investment Officer at Aware Super.
Hi, Vanessa.
Welcome to you both, and thanks for helping solve this one. This is a big one and we've all got a lot at stake. So let's get down to it and have a chat. When we've talked off camera, I've had some great lessons from you, Stephanie, around how terminology works, and some phrases mean different things to different organisations, and so people have become a bit confused. Do a bit of an outline for me on when we talk sustainability, what's that range of definitions?
Sure, happy to, Vanessa. Given the terms are interchangeable, I'd like to sit and try and define some of those today, if that's okay.
Okay, but because I was really interested to hear you say an impact investor versus a sustainable investor.
Yeah.
And the difference being that an impact investor was willing to let go of some return.
Not necessarily. The impact investor the impact investment should have two prongs of focus. It should be both the investment return, but also a positive societal or environmental impact that is measurable and can be seen where your money is going, is helping to achieve those goals. So that historically has occurred much more in the private assets space and tends to be quite a concentrated or a specific asset-based approach. Then if you take a step back, you've got sustainable fund range. So all of the listed asset classes, for instance, have got things like ESG data, you've got active ownership, you've got proxy voting. The conversation there can be very broad. ESG integrated funds are probably the most broad and tend to be broad-based strategies, predominantly historically more in the equity space, where there's a lot of data coverage and there's deep depth in the market. So you can, for instance, exclude something that aligns with either your E, S and G values, or you could exclude something on ethical grounds such as tobacco. Then you've also got active ownership in those ESG integrated strategies, and that includes professional investors going to companies and not just having that backwards looking focus that often comes out in the ESG data, but trying to better understand where is the puck going to, what's the future going to hold for this company? Have they made climate change commitments? How are they going on achieving those commitments? So this can be in an ESG integrated fund, which has got traditional financial analysis, and the investor will generally tend to integrate those ESG considerations and make sure that they are being compensated for any identified ESG risks as part of those company valuations, for instance.
Okay, I'll stop you there. That's a lot to think about, really, and I'm interested in, and I understand the piece, it might be easier to screen equities than other things,
Yes.
other asset classes. Damien, going now to you, the Chief Investment Officer of one of the biggest super funds in the country, and you have been known for this, I guess, more than most. So for as far as sustainable investing, talk to me about how you see it from a world view first when you look at the fund and what you're achieving for members.
Yep.
And then I want to explore this concept of return, and we talked about with impact investing, do you have to give up return? Because a lot of advisors are going to be watching this and thinking, look, I need to start talking to my clients about it, but what they don't want to be doing is talking about why you would get less return for doing the right thing. Because we don't want to go against human nature, which is everyone wants to do the right thing, but they also want to make money for themselves. So how do you look at it with that macro lens?
Yeah, one of our investment beliefs, Vanessa, is that we need to invest with the thoughts around ESG and impact, and if we do that well, we'll actually deliver better returns in the future. So it goes to a lot of risks that come through with environmental risks or social governance risks. If we don't manage them well, we think we won't do as well for our members. So we don't believe you give up returns. I know that's some
It's
people
good
think
news,
you do.
really. Yeah.
We think it's important, and we think it delivers better returns in the longer term. Maybe not year in, year out, but on a long-term basis, we think it manages risks better, and so should give you a better risk-adjusted return. When you think about it globally, though, there's no doubt some of the issues that Stephanie's mentioned around the need for the world to transition to a lower carbon future. That's absolutely critically important for us all. So we have very much thought, and this is not something we've started recently, this has been the last 8 or 9 years at Aware Super, where we've put in place planning to really adjust our portfolio to meet what we think are the key outcomes. So we have a goal to reduce our carbon emissions by 45% for our fund from 2019 by 2030. In the listed equity market, for instance, we have a goal to reduce by at least 30% in the first 3 years. We've reduced by about 45% for our listed equity portfolio in the last year and a half. So that's a really strong focus. Now we're moving to the unlisted markets, so the assets we hold in property and infrastructure and private equity, much more complex in how we reduce the carbon emissions there. But we've made some significant private investments. So we've invested more than $1 billion in renewable energy in the last 18 months. That's abated about 6 million tonnes of carbon. So it's making a material difference for what we're doing. We also went through a process which I think, and we were talking earlier about the need to make some progress. If you wait for the perfect solution, it's not going to happen. These are complex challenges, as you know, the wicked problem.
What was that good term you used for me? Was it?
I said progress over perfection.
Yes, I like it. Progress over perfection, yes.
It's just critical, because if you wait for the perfect solution, you're not going to make any progress at all. So we've very much felt that we need to be making progress across where we think the important and measurable and actionable outcomes. When we think about, Stephanie, you were talking about the difference between ESG, sustainable and impact. We look at it slightly differently for our portfolio. We look at 4 key areas of activity. We want to manage ESG risks because we think that's a very important thing to deliver better outcomes. We want to be focused on investments that we think have a positive impact. So again, where we can find assets that can deliver great returns, but also deliver that positive societal impact. It may be carbon, it may be societal impact. We're very focused at the moment on affordable housing, so we've been investing in that area.
Which is huge, right? I mean, I've always congratulated you guys on LinkedIn every time you get a property up, because it's so important that we have this.
It's a big problem for us,
yeah, it is.
For Australia, and the government's obviously increasingly focused on that as well. So whether it's that issue, then we think about engagement, so how we're engaging with the listed businesses that we own, very importantly, because if you look, we went through a process of benchmarking our total portfolio. So we have between 13,000 and 14,000 different investments. We benchmark that holistically, and if you look at our carbon emissions, it's about 75% from listed equities.
Wow.
About 25% from private investments. So it's still very biased towards how we engage with the big emitters, the big companies, to try to help them to transition to that long-term outcome of lower carbon emissions.
And is that what you talk about, active ownership? Is that where you're
Active
in partnership,
ownership.
and rather than saying, no, you're doing the wrong thing, we don't want a bar of it, it's we'll own you and work with you to get to the right thing?
That's the goal. So again, we invest through Shroeders as well, so working with the equity team there, and we do that more holistically as well with all our managers, but voting directly, whether it's through proxy voting or whether it's actually through meetings with the management to say, help us to understand how you're going to transition to a lower carbon operating model. And that's really important, because as I said, a lot of our emissions are coming through the listed market, globally as well as domestically. So we've got a very strong focus and have for a long time. And then the last piece that we focus on is advocacy. So how are we advocating with policymakers, with government, to try to help them to put in place the policies that we think will drive those positive societal outcomes. And it might be around climate, maybe what's happening and governments are very focused on this clearly. They know the size, or they're identifying the size of the issue, and they're really looking for the institutional investment area to help support transition as well. So, you know, we talked to the New South Wales government about what's happening with their renewable energy zones. Clearly the federal government's outlined their rewiring the nation, you know, their big $20 billion spend. So they need a lot more money that's going to flow with those initiatives to drive the outcomes they need. So if you look at the global view, there's literally trillions and trillions of dollars required over the next decades to get us to that zero emission outcome for energy. So it's a huge problem, even bigger than a wicked problem. It's a
Is there a bigger, hugely wicked problem?
Hugely wicked problem.
But it feels like the government's more aligned now. Am I, to getting things done? Would you guys agree with that?
Yes, I would. And I'd also say regulators are coming to the party as well. We've seen in other regions like Europe that political and regulatory moves have happened far in advance of where we're at in Australia, and that's had quite significant impacts on the way that sustainable investment funds are communicated to clients about and how advisors have to communicate to clients about.
Because this is big, right? This has already happened in the UK, and so advisors...
It's coming. Everyone's working through that.
Okay.
I think it's due early next year. And it's something I believe is called MIFID, which is where advisors... Another fun acronym, sorry everyone. But it's where advisors have to ask their clients about that client's sustainability preference, and based on that outcome or that answer, there's certain sustainable funds that they can or can't direct the client's investments into, and that's regulation.
That sounds very positive.
It's very positive. It's a new level of education that's needed for the underlying client, for the advisor, and the way that managers and people that manage funds communicate to both of those sets of people too.
Okay.
And certainly the regulators in Australia too. If you look at APRA as the key superannuation regulator, have for a number of years required super funds to consider climate risk as a financial risk. So it's been critically in the requirements for trustees to be able to do that, and ignoring it is obviously not something that's allowable.
Maybe because I'm a coal miner's daughter, which I actually am, even then,
okay.
I feel like Australia has been late to the party on sustainability for a lot of reasons, not that we're a producer that digs things and from the ground, but talk to me about this term of greenwashing, because I kind of feel like it's like everyone then says, I am sustainable, I am also, like, because it's the cool thing to do, right? And then you get people then not trusting it. It's like people say don't give to a charity because they don't spend it the right way. Well, then who's going to give to the charity? You can't be like that. But talk to me a bit about greenwashing.
Can I mention one other point before I do? And that's just the transition to a lower carbon future. So I think one of the things that's really challenging, and again, a coal miner's daughter, you'd acknowledge this, that when you look at the different regions that have been focused on, coal production or coal-fired power plants, we did a research piece with the Investor Group for Climate Change, which I sit on the board of, around the transition for the Gippsland in Victoria, which is obviously traditionally a very digging coal out, burning it, obviously creating a lot of energy for Australia. So that transition's really challenging, and that's why I think it's a big problem about how the government supports investors, but also the economy and communities to transition to away from coal. So a big issue. But greenwashing, as you ask, that is a fascinating issue, because again, I think one of the key things you've got to be is genuine. So when I talk about making progress, and it doesn't have to be perfect, clearly you want to make sure what you're saying you're doing, you're actually doing, and I think the regulators are really focused on that, and that's a global issue, not just Australia. And we've certainly seen a number of examples of global regulators looking at fund managers or asset owners or just the finance sector in general and saying, hey, you're saying you're doing this, but you're not quite doing it as well as you say you're doing it, or you're actually not doing it. So, we need to be genuine in what we're doing, and that's how we're going to make real progress. But the regulators are increasingly focused on ensuring that people aren't saying things that they're not doing.
And I think that's where the super funds and fund managers like Shroeders have a competitive advantage, because you've always been doing that. I mean, you've always been disclosing, you've always, followed the rules, so to speak. So I guess, it gives people confidence that there's going to be a level of compliance and getting it right at that level. Now, I talk to advisors a lot, and I host a lot of advisor events and forums. And one I did not too long ago was I said, how many clients are interested in talking about sustainability? And they were about 70 or 80 advisors of high net worth clients. And only about 15% said it was really high on the list.
Okay.
And more than half said not really on the radar. And I was like, wow, I was quite surprised, but it shows what a job we have to do to get advisors to get to the level where they're actively, interacting with their clients and saying, this is important, this is a really big issue.
Well, on that point, we recently released a global investor study which obviously had surveyed participants, but they were retail investors from each country around the world, but over 1,000 Australian retail investors participated in the survey.
Okay.
And of that, 75% said that sustainable funds were deemed attractive. So, half of that cohort then nominated environmental themes as of interest. I think that what I'm witnessing is it's an increasingly fast changing space with lots of shades of grey, and it's really difficult to confidently say I can screen out a part of my market and I've solved the emissions problem. So this is where the difficulty lies, in that you've got some people arguing we want a just transition, which Damien's already touched on. We don't want to lose power and turn the lights off too quickly before, things that we keep reading about in the press about what's happening in Europe and all those sort of specific issues happening with their energy crisis over there. So I think it's quite important for everyone to understand that now that we've got regulators and political and broader business support for net zero transition, we're now moving on from the conversation of should we do this or not, but how do we do this? And get ready for more shades of grey, because it's you've got to almost have a seat at the table and be a participant in corporate engagement and not just divest your emissions, because then you lose your voice at the table. So we have recently, Shroeders has made our own net zero commitments by 2050, and they're science-based and they've been externally validated by the Science Based Targets Initiative. We're one of the first and one of the largest fund managers to have gone through that process. And a key component of us reaching our own net zero commitments is encouraging companies to make their net zero transition commitments, and then to keep monitoring and encouraging progress against that, and then all boats should rise. So I think I saw a recent AXI report which said the Australian equity ASX 200 in 2021, I think it was 2022, 90 companies out of the ASX 200 have now made net zero commitments, and that's double from a year previously. So it's moving a lot, and you don't want to just exclude on backward-looking emissions data or where you are today. There's a lot of companies transitioning, and you need to be talking to people rather than waiting on sort of lagging data to be able to see that coming through. And that's where we feel like, especially passive investments, there's a slight weakness in trying to be sustainable in a passively invested strategy that just systematically excludes based on backward-looking data. So it's about looking forward now and trying to see where everything's moving to. So it's
that's super
complicated.
interesting.
Yeah.
Damien, tell me, I mean, your members that you're investing billions of dollars for are teachers and nurses and the good people of the world that make society run. Are they interested in this on a day-to-day basis? Talk to me about how members, because I love member education. Are they wanting more? Are they?
It is the highest issue that we hear from them about.
That's
Again,
good.
Year in, year out. I'd say right now returns are very important, but year in, year out, climate transition is the number one issue that we get feedback on from an investment perspective. So our members are very focused on it, and if you look at, again, the nurses, the teachers, ambulance, police, tend to be more focused on community outcomes in general terms. I think a general statement, but that's certainly how we find. We did some research many years ago which I thought was quite interesting, and it sort of goes to a question you asked earlier around do you have to give up returns, because the feedback was how would you perceive a super fund that had a firm plan on how it was going to approach ESG or sustainable issues, and the feedback was that they would have a higher, more positive view on a fund that had a well enunciated plan. So that makes sense. But at that point in time, the feedback was they didn't want to pay any more for it, and they didn't want to give up returns for it. So I think we need to deliver those outcomes in a way that's it's good value for money, but it also can deliver good, strong long-term returns. So I think that belief we have that it adds value is really important.
Thanks everyone, and that's all for this episode of Wicked Problems, Visionary Investors. Next week, we hear from our live studio audience of advisors and tackle how they can get the best outcomes for clients who want to invest sustainably. I'm Vanessa Stoykov. Thanks for watching.